Today's discussion, folks, is just a re-talk about fixed income, an area that a lot of folks, kind of go, I want to talk about the stock market. But I thought with our last discussion in May, we brought on just what we find to be really just one of our most powerful allies, and that's Tim Paulson from Lord Abbett. So I want to welcome you, Tim, to today's webinar.
Thanks a lot. Had a lot of fun last time we did this. Really enjoyed talking about markets with you. I think there's a lot out there still, even though things have calmed down from a volatility standpoint. Should be a lot of fun.
Well, thanks, Tim. And again, I think what I would like to do is keep this, a little shorter than we did last time, so the information really can resonate with the folks listening today, and we'll do rebroadcasts. But it powerfully what's going on very much so in the news is the election, right? So you get asked that whether it's the equity side, you get asked that whether it's the fixed income side. So in your words, Lord Abbett's thoughts, you're the global market strategist of one of the most reputable firms on Broadway. Give us, Lord Abbett, and your thoughts on the fixed income market in relation to the upcoming election.
Well, I'll caveat everything I'm going to say first with the fact that somehow whatever's in the news, investment people think they're experts. It could be hurricane back in 2005 or oil rig counts or whatever it is, but there's no question that investment experts are complete buffoons when it comes to elections. In fact, as one of our co-heads of fixed income says, if you gave everyone the future of what would happen in the election, they would still get it wrong when it comes to investing. So there's the caveat. And the reason I'm saying that is because we put so much emphasis on the election, and it starts to take on huge amounts of importance as if this is, world-altering stuff. And yes, it's important, but we over-assign the weight of it in terms of markets. There are a lot of other drivers of what's going on in the market right now. It's easy to get people, and frankly, people win elections by using fear and you must vote for me or else the world's going to end or change. And the fact is that the US government is built to resist change, to resist the impact of any one person. We've gone and looked back historically, and I'm sure, there's tons of analysis. The only conclusion you can draw from what party wins, from what they say they're going to do, from having a, same party win in Congress or different party, whatever else, the only conclusion you can ever really draw is that markets tend to do better after elections. There's so much uncertainty going in that people risk off just a little bit. And then regardless of who wins, even if it's supposedly a negative for the markets, and we can recall what happened in 2016, everyone said that if Trump won, it was going to be a disaster for markets, and you had like 8 hours of everyone hitting the sell button, and then markets shot up for the next 3 months. So a lot of that is just that markets don't like ambiguity and uncertainty. And once you know what the rules are, once you know what kind of world you're investing in, people can start to allocate money and make decisions. I will make one last point, which is that if you think back to 2000, it took months for the actual election to be resolved. Typically, markets will assign a certain amount of premium, volatility premium. How much is uncertainty going to be out there? That kind of goes through the election period. Right now, that's kind of going through mid-November. There is a chance that markets are kind of underestimating the chance that this could extend. Maybe it goes to the Supreme Court, some kind of contested election, whatever it is. And it's very clear that both sides are, out there trying to, already laying the groundwork for if the other person wins, it's not legitimate. There's every chance that this drags out, and that could lead to some kind of real volatility and kind of instability in markets throughout the, months of November and December. So it's something we have our eye on. It's not a high probability, but it's certainly out there.
Sounds like the same story as last time. It's the election cycle. And as we always tell our clients and friends and family is, we use history as a guide. And as you pointed out, Tim, it's really factual. It's not the guesswork. It's saying, let's go back to past election cycles. And it's factual that these things iron themselves out. So I just wanted to get that out there because there's a lot of discussion on that. But obviously, going back to May, the big thing that happened with us was what we're going through right now is this disastrous issue with the COVID. Okay, and its impact on the market. Now, we also noticed that businesses have suffered, but some have come back. Here in New York, which was one of the hardest hit, it seems eerily coming back, eerily normal. Once you learn to wear the mask, you're good. But what's happened is there's a big discussion on interest rates, and we get a lot of calls on refinancing and buying homes. In August, in Jackson Hole, Jerome Powell, head of the Fed, came out and announced he is going to keep interest rates low for a while. And it really was to maximize employment. So give us some thoughts on that. What does that mean to you from a fixed income thought?
Well, when we spoke last in May, I gave you what I felt was a really constructive view on credit and on risk assets in general. And a big part of the rationale for that was low interest rates. And you can even contrast with elections dominating the news, and that kind of takes up mind share. But the reason that ultimately you shouldn't put too much weight on it is because the big elephant in the room is low interest rates. Low interest rates drive asset values for everything, not just for what you're earning with your cash or for your bond portfolio, but every single asset class should be viewed relative to interest rates. If you're looking at some kind of dividend yield on equities or whatever your valuation model is, suddenly stocks look cheaper with rates low. And now, as you say, the Fed has done what a lot of people expected them to do, which is commit to low interest rates. So the Fed has a number of policy tools at their disposal. The most obvious one that gets a lot of play is the Fed funds rate, which is really just where banks earn interest on excess reserves that they deposit at the Fed. I mean, this sounds like a really wonky thing, but that in turn drives lending decisions the banks make, and it trickles on out to the rest of the economy. Well, that's at zero. There's not much the Fed can do there. So another tool is quantitative easing, adding assets to the Fed's balance sheet, getting more cash into the economy. That one's cranking full time. And another one, and this is a playbook they broke out following the financial crisis, was forward guidance. Not only are we going to keep rates low, the Fed funds rate low, but we're going to promise you that it's going to stay low for years. What that really does is kind of push everything out several years. So now 2-year treasuries, they're going to be pinned. They're not going to move. I mean, a few basis points here and there, but really there's no interest rate risk, because if you buy you might 3 years from now be like, aha, look, the 2-year treasury went higher. It's like, right. Those 2-year treasuries didn't exist back when the Fed committed to keeping rates low. We forget, like, these things mature and run off. If you buy a 3-year treasury today, you're getting all your money back by the time the Fed's hiking. That's kind of what the Fed did. Why did they do this? Well, they've been hinting around this for years, but there's been a growing disconnect between employment and inflation. There are a lot of theories about it. The fact is, inflation is one of the hardest financial metrics to predict. There are always new variables. We can talk about the role of technology. We can talk about globalization. We can talk about labor force mobility. Whatever it is, there used to be a much stronger tie between, oh, wow, gee, unemployment rate's really low. That means labor markets are going to be tight. Boom, here comes inflation. Well, that didn't happen. The Fed has now gone and explicitly said, we kind of made a mistake. We hiked rates too early back in 2014-15. We don't need to do that again. Anticipating that inflation might go higher, we're going to wait to see actual inflation. And not just approaching 2% or a little uptick, but we want to see that we want to really believe inflation is heading above 2%. This is using the Fed's PCE, core PCE metric, not CPI. So that tends to run a little lower. So we really are going to have to see material inflation before we ever see the Fed hike again. And that could mean unemployment rate down 5, 4, 3%. It doesn't really matter anymore. If they start to see real problems in the labor market, like big job vacancies in certain areas, everyone trying to hire, some serious squeezes, yeah, the Fed might think about it. But this has really important implications, because when the Fed tells us rates are going to be low, don't worry about employment getting too tight, don't even worry if you start seeing inflation go up, we're keeping rates pinned here, we're going to keep our foot pressed down on the gas, everything else looks cheaper in your portfolio. Again, think of anything you might invest in. It could be real estate. It could be growth equities. It could be, a dividend growth strategy. It could be bonds, gold, whatever it is. Suddenly with rates lower, those tend to go up. That means the risk is that if rates do go up, if inflation starts going up, your whole portfolio can start to be impacted by it. But now we're being told that at least stuff sensitive to short rates, no risk for the next several years.
Interesting. And, and really one of the great calls Lord Abbett made back earlier in the beginning of the crisis was just to address this issue of where do we go to get some yield, okay? And as you just mentioned, based on the predicated thought process of inflation and rates was to stay shorter, okay? To stay on the shorter end of the yield curve, which meant you're going to get lower rates. But then how do we go out there and get a higher return for our clients? And one of the points that was brought up in May, we actually brought over as a part of our portfolio was high yield, okay? So importantly, back in May, we brought up the fact that the Fed had then uniquely said, we're not only going to back treasuries, which they always do, obviously, and other debt, but we're going to back high yield. So can you give us an update on your thoughts on high yield as part of a portfolio in the fixed income world right now?
Yeah, I think you nailed it when you framed it at the beginning, which is there's a need for yield in the world. It's kind of amazing. Almost 95% of the bonds around the world yield less than 2%. Globally, that's not much yield, and people need returns. There's capital out there. It's tied up. It's doing something. Just, here in the US alone, you think about the number of people who are moving into true retirement. Retirement age just keeps getting extended, but more and more people are really kind of needing some level of income. We have a template in Europe. We know we're not Europe, fortunately. We've got our own problems, but things aren't kind of economically and financially as bad as they are in Europe. But at least in Europe, we can see what happened when they took rates to zero and then negative and held them there for a decade. And what you can see clearly is that for the first 5 or 6 years, the people that were first to act and move out of treasuries, whether it's Bunds or sterling or whatever it's going to be, sovereign debt, and moved into credit, they won. Spreads keep tightening, yields go away. Suddenly a 1% yield in Europe sounds great. But you've got this double whammy of money needs to get put to work, and the central banks are saying, hey, we're going to do whatever we can to keep the economy going, and part of that means we need to keep companies alive. Whenever this ends, and maybe there's going to be no finite concrete end. You're not going to have a magic bullet vaccine that instantly immunizes you and everyone can get it. It's just not going to work that way. So this is going to kind of drag slowly. But as you get recovery, as demand comes back up, as you want to start going to do things you used to do, you want to make sure it's there. And so the Fed has very clearly said they will do whatever it takes and that they have a lot of dry powder to keep these companies afloat. Quick numbers. The Fed has $750 billion in balance sheet at their disposal to lend to companies, whether that's buying the debt or direct lending. The Fed has currently about less than 25 billion of that deployed. So there is a view that credit spreads have done really, really well over the last 5 months because the Fed's buying all this stuff. The Fed has in their much hyped corporate credit purchase facility, they bought 17 billion. That hasn't moved, and we have multiple funds bigger than 17 billion. That's not why spreads are tighter. They're there because what they're really doing is they're greatly reducing default risk. That's great for corporate credit investors. I don't know if earnings are going to be strong, if you look over the last few weeks, you've seen a lot of bumps and volatility and uncertainty in the equity markets. Well, corporate credit's holding in fairly well. Why? Because we're worried about earnings, but not defaults. And the Fed is backstopping this. There's a structural need for credit, and there's almost $4 trillion in the US sitting in government-only money market funds, earning zero. If you want to put money in a T-bill ETF today, it's yielding 10 basis points. You have 12 basis.
That's 0.1%.
That's right, 0.1%, and the fees you pay for that ETF are 0.12%.
So you're going backwards.
You're going backwards. That's right. And it's going to be like that for years. How long can people sit there and say, I'm really nervous, I just want to protect my money, I'm going to pay 0.02% every year to not lose money with all my money? That becomes untenable. At some point, people start to say, gee, you know, I am seeing some return to normalcy. Maybe Walmart's not going to default. Maybe some of these other companies are not going to default. Maybe I can earn a little bit extra. And you start to see the experience other investors have had. And so this continues. And I'm not saying it's going to be a straight line. It never is.
Yeah.
Ups and downs. You feel good, you feel bad. It's human nature to sell when you feel bad, which is the exact wrong time. That's why we have, frankly, people like you helping protect most investors from their own kind of more emotional decisions. And people like us too, you know, really to be out there and say, you know, some of this is overdone. There's a lot of value here. But this is the type of environment where credit does exceptionally well. You ask about high yield. It was shocking. Specifically, it was shocking for the Fed to say, doesn't matter what your credit rating is. But then if you step back and think about it, why is the government, you know, saying, if the Fed's coming out saying, we want to support corporate credit in general and keep these companies alive, why should they artificially cut themselves off based on how S&P or Moody's rate something? And they're not. They're just saying, we're going to look at, you know, balance sheet leverage. If you're a super risky entity, yeah, okay, that's your own doing. But, you know, if you're a reputable company, we're here for you.
Which is an amazing thing. And again, the multiplier effect here is not only you picking up basis points and percentage points in yield, but you also have the other effect of as time goes on and they become a capital appreciation, the bond itself. After that dramatic hit early in the crisis, you get two ends of it. So this is what we're using, and obviously with having you know, Lord Abbott to talk to, we believe we can capture the fixed income market on by doing a sort of a barbell, right? We do the very conservative short end, and then we bring in the high yield, but with that extra backing, it's a lot easier to talk about high yield, which just for folks who aren't totally familiar with it, Tim, give just a 2 minute on, or a minute on what is high yield?
So high yield, and you'll see people call them junk bonds or high yield just based on how they're leaning and biased. But the fact is, these are companies with below BBB credit ratings. That doesn't mean they're bad companies. Ford is a BB rated company. Kraft Heinz is a BB rated company. They're junk companies, which really just means that they have a higher ratio of debt on their balance sheets. Well, we're a little less worried about servicing that debt because rates are so low. But you know, for a lot of these companies, it just means, wow, they had a revenue shock. It dropped them down in credit ratings, but they're still earning. They're still doing what they can. The upshot is markets assign a higher probability of default to these companies, and an additional premium on top of that, just because of the name or the category or what have you. So some investors avoid it. But you earn a decent spread, extra yield over treasuries for investing in these companies. Some of them default. That's okay. We have a lot of defaults here in the US. Great workout process. High yield or junk bond investors recover some of that back. So there's some of this is already priced in. You know, it's expected that we're going to see more defaults. That doesn't mean investors will lose money. I mean, I'll tell you, we happily invest in companies that we think are going to default, knowing that we're going to recoup more in the default than we paid for the bonds. So, you know, it's a business that requires a lot of dig in there, look at the balance sheet, work on the restructuring, think about how that works. But for the most part, you're investing in really quality, well-known companies and getting a decent amount of incremental spread. So just to put some numbers on it, right now, if you want to invest, I'll just pull it up right here. But if you want to invest in double B only companies, where did this go here? You're going to get paid an extra 3.6% over treasuries, right? So 10-year treasuries yielding less than 0.7, suddenly you're talking 4.3%. Not
That's a big number.
So that's a big number.
Yeah.
You expect you'll lose some from defaults, what have you. But historically, even in the worst periods of defaults ever, you've never come close to losing that kind of number. So really what you're doing is saying, let's say things get really bad and we lose really bad, 2% of that 3.6% head start. Well, you're still doing way better than you would have if you were in treasuries. So for investors that can have a little bit of a longer time horizon, who can withstand some headline risk, you just simply out-earn treasuries with these. And they make a lot of sense. And I've talked to some investors, some really big, running multi-billion-dollar pension funds, and they kind of compartmentalize the world. No, we need our bonds to be safe. We're not looking at a high yield. We're going to put some money in equities, though. Just to be clear, you realize these are the same companies. If they default, the equity's worth zero, and the bonds are going to be worth maybe 40 cents on the dollar. And like, oh yeah, why do I think that way? So there's a little bit of a bias that way, which is why these historically are cheap. And just to put some numbers on it too, over the last 20 years, high yield has returned just over 90% of S&Ps. It has about 55% of the volatility. That's
an amazing statistic. Folks, just so we're clear on that, what Tim is saying there is the high yield actually captures similar returns to the overall market, but the downside risk is significantly less. Now, there's a caveat here, and the caveat here is, what high yield are we buying? We have a unique period here where the government and the Fed is backing this, but as Tim and I have spoke for the years, you better have somebody in there looking at the balance sheets and looking at the numbers, because all high yield is not the same. And again, we're not just here to be a puppet for Lord Abbett, because we're not married to Lord Abbett nor their strategies, but they have been a firm with their well over a century of history that has been able to build portfolios, but also do it in a smart way that keeps the investor getting the returns, but not having extraordinary risk. And the key point is, as Tim brought up, is they do understand that some of these will go away. Some of these may not work, but it's the law of large numbers and the fact that they don't bet on one company, they bet on a portfolio. Is that right, Tim?
Yeah, I that's right. And, it just made me think of another point, which I think is so important for investors, which is, markets are pretty efficient. Over time, they're very efficient. And what that means is, if you're reading about it in the news, it's in there, it's priced in. If you say, hey, I heard there's going to be upticks and defaults, it's in there. You're being compensated for that. If you read that, Manhattan real estate's going to drop, it's in there, it's priced in.
Yeah.
So if you sell something because you heard it's going to go down, no, it already went down. That's done. Our job is to be one of the folks who is a first actor in that. But even then, we recognize, market, they move fast. When there's new news, boom. So our job really is to ask, are we being paid appropriately for the risks? Are we being paid for the uncertainty? And that's what you as investors should be thinking about too. Not, hey, I read this is bad, but over a long period of time, what's the uncertainty here and how much compensation do I want for this uncertainty? Does this work out? By and large, high yield really captures that very well.
Yeah, it's something, again, I think it gets a bad rap. It goes back to the junk bond days of Michael Milken, but here we are, and it's working for us. Again, a last topic, Tim. We get calls on it occasionally. Is the discussion about inflation, and where does the infamous gold fall into this sort of discussion? As everybody knows who's watching it, it's gone from a bottom number to a record number recently, and as we all know, there's a rush to gold, but we always know it can always end badly. So give us your thoughts on gold and just general, materials and commodities in this inflationary area if it comes up.
Well, so the rationale makes a lot of sense, which is the idea, okay, central banks around the world are just exploding their balance sheets higher. They're pumping money into the system. Governments around the world are spending. This is inflationary. But even more importantly, what it really feels like is we're just degrading the value of the dollar. So let's put our money somewhere else. And that intuitively makes a lot of sense. But empirically, we have we have, in the same way we can look at Europe for saying what happens with low rates. There's a country that wrestled with this 30 years ago, where they had a huge recession. They started, central bank was gobbling up assets, their deficit spending. By the way, our debt as a percent of GDP was roughly 100% when we came into COVID. And by the time we're done with this year and the spending and whatever package of Congress ever passes, we're going to be about 130%. If I tell you that there's a country out there with 250% debt to GDP, that's actually going to be closer to 300% at the end of this, that sounds pretty bad, right? And then if I mention it's Japan, and that investors have been betting against the yen and betting on yields going higher for really 30 years. And we've been calling that bet against the Japanese currency, degradation of the currency. It's been the hedge fund widowmaker. That has put more hedge funds out of business, because the simple fact is that when you're a large developed economy and you've got substantial assets and you've got a global asset base looking at it, it's not as simple as just saying, poof, we're spending, the currency's worth less. What we've really seen is, as you would hope for the world's reserve currency, when everything fell apart with COVID around the world, the dollar went a lot higher, even though we were spending, because investors were grabbing it. As things have gone back to normal, it's come back down, and some of the premium, a lot of the premium on that has gone away. And now it's just more about relative economies. China's had a V-shaped recovery, ours is more dragging. On average, you would expect the dollar to just kind of weaken a bit, which it has. Does this mean the dollar's free falling? No, it does not. So really what it comes down to is, are we doing something that is structurally deeply inflationary? There is a risk that we could overshoot with inflation. There is also a risk of deflation. I believe that what we're seeing from the Fed and some of the kind of numbers in recovery have greatly reduced the risk of deflation. But I'll try and say this cleanly here. The base case right now is that we're going to limp along with steadily increasing inflation using the Fed's metrics. We're going to, 1.5, 1.6, 1.7%, maybe. And right now the markets are pricing in for CPI like 1.9% over the next decade, right? That's reasonable. What's changed is that doesn't mean that everyone says we're going to have 1.9%. That means that's kind of the average expectation, and the chances of much higher or much lower are elevated because there's all this uncertainty out there. I understand the need to defend against the risk of inflation. If we think about how tied assets are to interest rates and inflation, this is a big deal. The Fed's not going to move short rates, 2 or 3 year rates for years, for 2 or 3 years, right? The Fed doesn't control 10-year rates. Those are going to be sensitive to inflation. So what's happened out of Jackson Hole, for example, is what the Fed has said is we're keeping short rates pinned. That's not going anywhere, but these longer rates, and I'm doing these little visuals because I tend to do that. The risks of 10-year treasuries going much higher have now increased. There's a floor. They're probably not going below zero. The Fed doesn't want to take rates below zero. They've said that. So there's an asymmetry here. Longer dated interest rate risk is really tough. So what's happening also is we see people going into gold. Great, makes sense. What drives gold prices more than anything else? And what have we talked about? Interest rates. People think that gold has gone up a lot because, hey, everyone's blowing up the dollar. No, gold has gone up a lot because rates have gone down. Now the opportunity cost for big in gold is virtually zero, right? If interest rates were 5% and you're sitting in gold waiting for it to go up, every year that it doesn't, you're costing yourself 5% of sitting in cash. Now, if cash earns you zero, why not be in gold? So I appreciate the value of gold in a portfolio if you really are worried about the dollar falling apart, about inflation rising rapidly. But you have to recognize that if rates go higher because of inflation, that gold's not going to work out the way you want. And so it's not a clean, easy hedge. And I worry a lot about chasing something that has a huge amount of momentum and that's in all the headlines saying, gold's up this percent, buy it now. That often doesn't work. So some of the fundamentals aren't quite there.
It's really right where we sit, Tim. And as we start to wrap this, this discussion up, that is what's key is the noise. We have it as we have a trademark on tune out the noise, and we use that so frequently because our goal, our objective with our firm and for our clients, who we invite to these webinars, and we hope they will come only from the perspective of, we hope it brings a sense of understanding, AKA calm, in that we are doing things that make sense, but we're not doing things that are tied to the noise of the media. Because if we did, we'd be buying and selling every day and jumping to the next hot stock. We'd be jumping into gold and jumping out of gold. It's a problem. History is a guide. And using smart asset management teams, again, on a fixed income, we talk about Lord Abbett because they are historically one of the most reputable firms on Wall Street. They also have a history, and they have wonderful market strategists. That's just pumping Tim up, but we communicate well enough during the week that we understand that as trends start to change, like the high yield discussion, we will move there, but we're not doing it based on MSNBC or CNBC or Fox Business. We're doing it based on real historical data. So with that said, Tim, I want to really thank you for spending the time today. We'll do more of these as the markets, really dictate. Again, this is a pre-election sort of discussion on fixed income, and if we don't meet each other this year, we'll do this again in the new year. And thanks for your time. And folks, thanks for being part of this. It's important that we keep you informed so you can then come back to us and keep us informed with your thoughts. Have a great day. Tim, thank you once again. Again, thanks for being with us today. And please follow us on all our social media platforms, Twitter, Facebook, Instagram, and YouTube. We look forward to seeing you on the other side.